This is the World Financial Report on Radio with Harold Siegel. My name is Randy Marshall. Joining us via the telephone, our financial and diamond expert, Harold Siegel. We're taping our show on March 27th, 2015. Our time is 8:46 Mountain. Next week, due to the long weekend, Easter long weekend, we will be taping on Thursday. Don't forget, our radio show runs on 6:30 CHED in Edmonton, Sunday afternoon at 3. The shows are archived on Harold's two websites, streaming live anytime for you to listen to. His two websites, HESradio.com and rarecoloreddiamonds.com. We have a podcast through iTunes. All you need to do is go to iTunes and type in the World Financial Report on Radio, and you will find us. Subscribe to the podcast. The shows automatically come in. You can listen to them on your portable device at your leisure. As we say, we are portable. We go anywhere you do. This week, the Alberta budget came out, and all we can say is death by 1,000 taxes. In the United States, ground beef hit a record in February of $4.23 per pound. Americans, new study out, not spending gas savings, they are saving them. 47% of American households haven't saved a penny for retirement. You heard right, 47%. There's a Treasury ETF that bets on a rate rise in interest rates in the United States. How much money has it lost over the last few years? $6.1 billion. Greece could be running out of cash in a month. In fact, bank deposits plunge in Greece to a decade low. Greeks have pulled $25 million from banks in the last 3 months. And one thing we have not heard a thing on, and we brought it to your attention, I guess it would have been about 3 weeks ago, the United States needs to raise their debt ceiling. And so far, no word if that is going to be done or when. A couple of very interesting quotes in our free weekly newsletter. This is a quote from Richard Fisher, recently retired Dallas Fed chief. He says, well, what worries me is how totally lazy investors have gotten, totally dependent on the Federal Reserve, and I find this to be a precarious situation. Are we vulnerable, in my personal opinion, to a significant equity market correction? I believe we are. Also, interesting quote from Ed Yardeni. This is not investing. It's all about central bankers. These markets are rigged. And on the Drudge Report, as we tape today's show, a story from the New York Post, John Crudell. Stock market rigging is no longer a conspiracy theory. And they go on and they have a whole long story about how the stock market is rigged, and they do mention Ed Yardeni. Harold, you had said to me earlier in the week when we touched base that these times that we're living in right now are just times that you have literally never seen before. It's absolutely bizarre, some of the things that are going on.
It certainly is. Starting off with that pilot that crashed the plane in Europe, we're just absolutely shocked by that. But again, there's so many geopolitical situations happening around the world, and they're affecting the markets in a big way. And this week was no different. We saw big moves in gold and silver and oil and currencies and all that. But that doesn't determine the trend of the marketplace, because starting off with oil as an example. There's a lot of volatility. Oil prices went over $50, and that was based on the fact that there was fighting in Yemen. So again, that does not change the direction of the market. All it did over the short term was took some oil off the marketplace, and you see how the oil market reacted to that. So, oil could actually hit $30 or lower, and we are predicting that is going to happen. The fact is that over the short term, there is such a large amount of oil on the marketplace, and the fact is that it's hurting the price of oil in the futures markets. And again, we do believe that it could push the market further all the way down to the $30-$35 level. The other situation that could affect the price of oil is whether or not they take the sanctions off Iran. And if Iran's sanctions are lifted and they can start to sell oil again, that's going to bring a lot of oil to the market, and it's going to drop the price of oil down to the prices that we think is going to happen over the short term, which is going to be at about the $30 level. Now, we don't feel that the lows in oil that we're seeing at this point, and again over the next couple months, will continue, because I truly believe that these low prices in oil are going to force countries to stop producing oil. And that will eventually create a shortage in the market. There's been tens of thousands of people let go, from the oil fields up in the Dakotas. And I know the fact, and a lot of my clients have mentioned, that they're concerned about their jobs, or a lot of people have been let go from Fort McMurray and up in the oil-producing nations in Alberta. So, again, oil is a major problem at this particular point. And then you've got the speculators that are going to come in and try to support the market like they did last week at around the $45 level. We saw oil go to $52 this week and now back off to where oil is back down at this time to about $49.96. We do anticipate that the oil market will continue to fall. You also saw a lot of volatility in the gold market. Gold went up to over $1,200 this week, and again, that was based on the U.S. dollar. So there's a direct correlation between the U.S. dollar and gold, just like there's a direct correlation between the oil market and the Canadian dollar. So the lower oil goes, the lower the Canadian dollar goes, and basically, if oil hits the numbers that we think that it could hit, we could literally see another 3 or 4 cent drop in the Canadian dollar. So we are watching that very closely, because again, we do a lot of business in Canada and vice versa. So why did gold break above $1,200 if we're bearish on gold over the short term? And the reason for that is the U.S. dollar. The fact is that the U.S. dollar did weaken this week, and that's what made the gold market go higher. But that is not a long-term trend at this point. We do anticipate that the U.S. dollar will continue to stay stronger over the next few months, which could push gold down to $1,140, which there's major support, $1,100 where there's support, and ultimately possibly down to $1,000. And again, the reason that could happen is primarily because the U.S. dollar will strengthen against other foreign currencies, for example, the euro. The euro is one of the worst currencies at this point. In fact, is trading at about the lowest level that it's ever been at. And the reason for that is obviously what's happening in Europe financially, and now that Greece is possibly going bankrupt. Again, it's a very, very difficult time in Europe. On top of that, you've got the Canadian dollar falling, and that's primarily because oil prices have fallen off. But what you did see this week, which again proves my point, is that the Canadian dollar did strengthen somewhat when oil prices went back over 50. Unfortunately, we feel that, again, with the glut of oil in the market and everything going on, over the short term, we could see one major push that could push oil down to the $35 to $30 level. At that level, we'll reassess, but we could be a major buyer in oil at that particular point, and we'll certainly let you know, number one, when that date is coming, and number two, how you can go about getting involved in the oil market. Gold, we're very, very bullish on long term. Again, we don't trade gold. We don't recommend that you trade gold, because most people that trade gold or commodities or stocks in general lose their money. 90% of the people that trade the futures market lose their money. So we're never professing that you go into that unless you're an expert. And again, with the volatility in the markets and the manipulation in the markets, the fact that most markets are manipulated at this point, it isn't conducive to trading in the marketplace. I think that some people feel comfortable, when the Dow backs off, that the bankers are going to come back in and raise the market back up, and they see that type of trend and they feel comfortable trading it. However, look what's happened in the market this week. The Dow has been down. It's down again this morning. We're down to 17,662. The TSX is down 106 points this morning, trading at 14,763. We anticipate that the Dow will plummet this year. Again, the earnings just aren't there, and there's no credibility in the market. Most people know at this particular point, number one, just by the action in the market, but number two, what the experts are saying, that the Dow is not the place to have your money. And we could see a 2008 type of drop in the Dow. In fact, if we're talking 17 to 18,000 in the Dow at this point, where the Dow should really be trading right now is under 10,000. If it was not a manipulated market, the Dow would be trading on its own resources is, we'd be looking at the Dow trading at probably about 9 to 10,000, certainly not 17 to 18,000. So the fact is that if you're heavily invested in stocks at this particular point, there's a very good reason for you to be nervous and to be on the sidelines or to put stop losses in the market to protect what you have in the marketplace at this point. There's just no way in the world that the Dow or the TSX is looking strong. Now, the TSX is not a great place to have your money at this point either, because the bottom line is that a lot of the Toronto Stock Exchange, is based on what commodities are doing, and commodities are not doing well at this particular point. So, again, there's no reason to be in the paper asset market at this point unless you need to be for hedging or for tax purposes. In actual fact, I would take a lot of money out of the Dow at this particular point or the TSX and either sit on the sidelines or wait for better opportunities because, again, there is tremendous risk in the market. Now, there's a lot of talk that they may raise interest rates in the United States this year. Personally, I find that almost impossible to believe. With the debt of the U.S. in the trillions of dollars, any rise in interest rates is going to make paying that debt back much more expensive. I just don't see that happening. On top of that, with the fact that could happen, there's just no way that we see that they're going to raise interest rates, number one, because of the reason I just gave, that the interest on the debt would skyrocket. But then on top of that, you've got the stock market, which I think would fall substantially because of it, and the real estate market. So again, the chances of them raising interest rates is slim, but if they did do it and saw a negative response from Dow and from the real estate markets, then at that point there they would pull it off the table. So again, at this point here, I just think the situation in the markets are dire, and then add to the fact that we've got these geopolitical situations. There's no way in the world that Russia is going to continue to accept sanctions against them. Iran, at this point here feels that the U.S. is warming up and going to actually help. I just don't see that happening. I don't see it happening in any way, shape, or form. We've got some major enemies out there with ISIS and Iran and all this, and it appears, that President Obama just is going about things in the wrong way, and it's really upsetting people, especially with Israel. The fact is that the United States and Israel have always been extremely friendly because Israel is the only friend in the Middle East and has always been. And because of the Obama government, that is in jeopardy. And there could be major repercussions because of this relationship. So you've got, a Russian situation that is almost out of control, and we feel that sometime this year, with the sanctions against Russia and the fact that they're losing so much money, that is a recipe for a war breaking out in that area, and that could easily happen. The Chinese economy is not doing well. The real estate markets are in havoc. They're doing horrendous. And then you've got all these oil-producing nations that, again, are not making any money and cannot afford to draw oil out of the ground because they're losing money on every barrel of oil that they produce. So, again, that eventually will create a shortage in the market, and probably not this year, but going into next year, we could easily see oil prices go back to the $80 to $100 level. I just think at this point here that we're going to see oil prices lower. And again, I do believe over the short term that we are going to see gold and silver prices lower. Once that bottoms out, again, we do believe that we are going to see a massive rise in the price of gold and silver. And we're betting on that because our new businesses are all based around physical gold. And that will be coming out soon, I believe, in conjunction with bottoms happening in the market. We actually did receive our first kilos of gold, of 99.9% gold. We sent them to the refineries to make sure and have them tested, and so far they've tested beautifully. So we're getting very close to be able to bring our clients physical gold at spot price with no commissions. And again, when the markets do hit their bottoms, we'll be bringing this to you at a phenomenal time to make money back in the gold market again. But all in all, the currency markets have been everywhere. The metals markets, the oil markets, all based on what happened this week. But all in all, once the dust settles, we do anticipate that the Dow will go lower, that gold will go lower over the short term, but then be a very bullish market again. And again, we anticipate that the currency markets will continue to be volatile. So that's what happened in the markets this week, Randy.
Featured Diamond of the Week from rarecoloreddiamonds.com. Go to rarecoloreddiamonds.com. Click on Featured Diamond of the Week. You will see a .36 carat round brilliant cut fancy gray blue. It is absolutely stunning. You'll find a picture of it in our newsletter. Get our free weekly newsletter, the companion to our radio show. You'll read all the articles that Harold and I are seeing on a weekly basis. As well, you're going to hear the stories that we talk about on the show. Connect with Harold at rarecoloreddiamonds.com, rarecoloreddiamonds.com, or call 1-800-432-1022, 1-800-432-1022. Connect with Harold at rarecoloreddiamonds.com and speak with him about our featured Diamond of the Week. One of the stories that Harold touched on that is very, very important is interest rates. And interest rates going up. And there was a story, and we have it in our newsletter, that I found particularly concerning. The world's next credit crunch could make 2008 look like a hiccup. Is this why central bankers are so scared of raising interest rates? We are certainly living in strange times. An unprecedented monetary experiment is coming to a staggering end, and no one knows the potential repercussions. The total value of all global equities was around $70 trillion in June last year. That according to the World Federation of Exchanges. Meanwhile, the notional value of all outstanding derivative contracts was more than $690 trillion. Now here's the important part. It's worth noting the vast majority, around 4/5 of all existing derivative contracts, are based on interest rates. What could go wrong? Let's say the U.S. raises interest rates sooner and faster than the market expects. That means bond prices, which always move in the opposite direction to yields, will plummet. U.S. Treasury bonds are like a mountain guide to which most other global securities are roped if they fall. They take everything else with them. Who will get hurt? Everyone. But it's likely to be the world's banks, where even little mistakes can create big problems that suffer the most pain. The European Banking Authority estimates that the average large European lender still has 27 times more assets than it does equity. This means that if the stuff on their balance sheets, including bonds and other securities priced off Treasury yields, turns out to be worth just 3.7% less than was assumed, it will be time to order in the pizzas for late-night discussions about bailouts. Barclays has predicted that if yields on a 10-year Treasury bond revert back to their historical average, it would wipe out nearly a fifth off the tangible book value of European banks. Yes, you heard right, a fifth. This is what is meant by interest rate risk. It's big and it's real, and the banks know about it. Their answer is to hedge the risk with interest rate derivatives. It's one of the reasons why there are so many of these contracts in existence. So that's all okay then. Just one question, though. Who has bought these derivatives and from where? Why? Other banks, of course. This creates what is known as a counterparty risk. Bank A sells insurance to Bank B, but then Bank A gets into financial difficulties. A significant deterioration in their credit worthiness would be enough, and suddenly Bank B isn't as well protected as it thought it was. Indeed, Bank A might start struggling precisely because of the insurance it has sold to Bank B. What if it can't honor the contract? This creates a potential catch-22 situation. The derivatives work as long as they're not needed. Calling them into action renders them useless. This is precisely the kind of thing that occurred during the credit crunch. Banks stopped trusting each other. New rules introduced since they require banks to actively manage their counterparty risk. In other words, banks are being asked to hedge their hedge. Are you starting to feel uneasy yet? We have the full story in our newsletter. That is a huge portion of it. But Harold, when I read that story this week, I knew it was something we had to talk about on the radio show. We have about 3 minutes left in our segment here, but you can see the way the world is set up right now. If they raise rates, and banks are offside, we could very easily have another financial meltdown, and these derivatives, insurance policies, are basically going to be absolutely worthless.
You bet, Randy. We've talked about this for years now because it's an unregulated market, and it's in the quadrillions of dollars. It's growing to such a huge extent, and you're 100% right. As soon as interest rates start to go up, how are they going to manage these derivatives? In fact, they're so misunderstood. They're very difficult to get out of, and one of the major reasons in 2008 that Lehman went under was because they started getting out of their derivatives and all hell broke loose. So at this particular point, that's one of the major issues. And again, I'm glad that they wrote this article because this is something that we've been talking about for years now. And again, it's always been a major problem, and it should turn out to be one of the most explosive situations in the financial markets that we've ever seen. I hope that they can control it.
Connect with Harold at rarecoloreddiamonds.com. This is the reason we advocate hard assets. Hearing stories like that, you need an insurance policy in your portfolio today. Take a look at our featured diamond from rarecoloreddiamonds.com. It's a .36 carat round, brilliant cut, fancy gray blue. And you can see a picture of it in our newsletter. Even better, go to rarecoloreddiamonds.com and click on the link Featured Diamond of the Week, and you can see all the information there. You can speak with Harold personally and privately about investing in diamonds at rarecoloreddiamonds.com or call 1-800-432-1022. 1-800-432-1022. Now more than ever, you need an insurance policy in your portfolio. When we have a story coming out, the stock market is rigged, and Ed Yardeni coming out and saying this is not investing, it's all about central bankers, these markets are all rigged. And then you have a retiring Fed chief, as we mentioned off the top of the show, Richard Fisher, saying that he believes we are vulnerable to a really significant equity market correction. And he has said in the past that the Fed in the United States should not worry at all about stock market corrections. He is an advocate for raising rates immediately, getting them back to what he deems a proper level. And if the whole house of cards crashes in the meantime, he is okay with that. Of course, he's retired now, and Janet Yellen is in control, and I would suspect that she would have a very different take on things if the stock market started to plunge. More than likely, a lot of people, experts believe, that we would see another round of quantitative easing and interest rates staying low for a significant period of time. Even if they do raise rates, it would be absolutely minuscule in the years to come. But you can see from that story we touched on, derivatives contracts, banks insuring each other, it's a quagmire, and you need to protect yourself with hard assets. And that's why we recommend investing in diamonds, gold, and silver. And you can speak with Harold about investing at rarecoloreddiamonds.com or 1-800-432-1022. Going to come back and talk about the week in diamonds as the World Financial Report on Radio with Harold Siegel and me, Randy Marshall, continues right after this. Welcome back to the World Financial Report on Radio with Harold Siegel. My name is Randy Marshall. Joining us by the telephone, our financial and diamond expert, Harold Siegel. We're taping our show on March 27th, 2015, and it's Friday. Our time is 9/11 Mountain. Our radio show runs on 630 CHED in Edmonton. Don't forget, next weekend is the long weekend as we have Good Friday and Easter Sunday. Our radio show runs as well via streaming online from Harold's two websites. If you miss a show, on CHED, go to HESradio.com, HESradio.com, or go to rarecoloreddiamonds.com, and you can listen to the shows streaming there. If you have a portable device, maybe you're in the Apple world or the Android world, you can listen to our radio show via iTunes. Type in the World Financial Report on Radio, and our show is podcasted. In fact, it can pop on your portable device. You can listen to it anywhere you want. We're portable. We go anywhere that you do. Get our free weekly newsletter. It's the companion to our radio show. All the information that you hear on a weekly, and obviously all the information that Harold and I talk about, it's in our free weekly newsletter. You can go through it in 5 minutes or spend hours if you want. Connect with Harold at rarecoloreddiamonds.com and telephone number 1-800-432-1022 to get our free weekly newsletter we send out via email. RareColoredDiamonds.com featured diamond of the week is a .36 carat, round, brilliant cut, fancy gray blue. It's an absolutely stunningly beautiful diamond. I love the round, brilliant cut. There's nothing like a round, brilliant cut in a ring. And Harold, here's another one of those rare diamonds that is a museum piece, and someone will be lucky enough to have it in their portfolio very soon.
You bet, Randy. This is a very rare diamond. Number one, it's an Argyle. Most people think that the diamonds that come out of the Argyle mine are only pink, but very, very seldom will you get a diamond like this. This is a gray blue. It's a nice size. It's round, which is very rare, and the color on it is spectacular. But any of the top diamonds coming out of Argyle at this particular point are doing tremendously well, especially the vivid pink Argyles. The vivid pink Argyles, if you're lucky enough to own one of those, and when I say vivid pink, it's the highest saturated color. It's the best color that you can get, graded by GIA. And the fact is, if you own a vivid pink Argyle, look forward to a huge increase in the price of vivids, especially because we only have less than 5 years till the mine closes down. So anytime you buy the very best, you always get the most back for it, and that's true with these amazing vivid Argyle pinks. Now, they're very, very difficult to get. We've had a run on ours, and we've sold a substantial amount of them over the past few weeks. But the fact is that they're very, very hard to get. And if you're in a position to get a vivid pink Argyle, you're in store for one of the biggest returns that you will ever see on an investment before. We anticipate that the vivid pink Argyles could literally increase by 500 to 1,000% over the next 5 years as the mine is getting ready to close. 95% of the diamonds are under a quarter carat that come out of Argyle, but they're still known as the most concentrated form of wealth in the world today. And the fact is that to own one of these diamonds is to own a piece of nature's art. They're amazing, but they're also phenomenal investments. So again, the opportunity to get a vivid pink Argyle is real, but there are very few of them available, so they'll be on a first-come, first-served basis. Once the vivid pink Argyles are all gone, and that will not take very long because there's so few of them available, the next ones that will skyrocket in price are the colors just below vivid, which are fancy deep and fancy intense. So you really want to look at the fancy lights. They're of extraordinary value right now. They're less expensive because they're less saturated. However, they're still beautiful. They're a soft, beautiful color. And the fact is that the prices are conducive to buying them at this point, but they will skyrocket in price the closer we get to the mine closing down. In fact, these fancy light pink Argyles have increased 20% a year for the last 5 years. That means that if you bought a fancy light pink Argyle 5 years ago, you've doubled your money already. And again, with only 5 years left to the mine closing down, these diamonds will take on a life of their own. We're very, very excited about what's happening in the rare diamond market, especially with these Argyle pinks. Now, they're becoming more and more difficult to get because brown is starting to seep into the mine, so instead of the beautiful, fancy, vivid purplish pinks or the intense purplish pinks or the intense pinks, you're starting to get brownish pinks, and again, they're not as desirable as these amazing pink colors. So if you go to our website, rarecoloreddiamonds.com, you'll see our magnificent website. First of all, go to the loose diamonds. When you go to the loose diamonds section, you'll see all the different colors that we offer. Yellow diamonds, pink diamonds, deep flawless whites, blues, reds, greens, orange, purples, and then larger diamonds. The best investments of all at this particular point, I believe, are the Argyle pinks, because the Argyle mine in Western Australia really produces 95% of all the pink diamonds in the world, which is a puny number. It's only about 200 carats a year. That's all the pink diamonds that come out of that mine, and soon there will be no pink diamonds available. So to own an Argyle pink or to own a pink diamond in general is just a phenomenal investment that we believe will increase 500 to 1,000% over the next 5 to 10 years, depending on what colors that you get. Also, yellow diamonds are doing tremendously well, but they have to be flawless. The fancy yellows, the fancy intense yellows, the fancy vivids, and even the fancy lights, which are known as canary diamonds, are doing tremendously well. But these diamonds have got to be the South African diamonds, not the Indian diamonds, and you can tell the difference by the price and when you look at them side by side. The cheaper Indian diamonds that are sold by some of the firms in Canada that really don't know about the diamond business, they're very brittle and they lack that luster and shine, or fire as we call it, that you see in the South African diamonds. And they're about half the price of a South African yellow. So again, you'd look to spend about 20 to 25,000 a carat on a fancy yellow flawless diamond, where these Indian diamonds are about half that price. And again, those are diamonds that we wouldn't even resell because again, they don't have anywhere near the value of a South African yellow diamond that's flawless. So you want to look at our yellow diamonds, and they're magnificent. You can get involved starting in and around the $10,000 to $15,000 level and going up from there. These yellow flawless diamonds increase by about 15% a year. That means over a 10-year period, you can make about 200% return on your invested dollar. Now, again, the same as with pinks. It's the vivids that return the highest amount because they have the highest saturation of color. And if you look at the fancy vivid yellow flawlesses, there's very few of them available. They're very, very difficult to get. Especially in the rarer cuts like the rounds and the emerald cuts. And we do have a couple new diamonds up on our website that are absolutely unbelievable. We have a 2.09 carat emerald cut, fancy, vivid yellow, internally flawless diamond that will literally take your breath away. It's one of the most beautiful diamonds I've ever seen. On top of that, you've got a 190 emerald cut, fancy, vivid yellow flawless diamond that is just so ridiculously rare. There's a 151 emerald cut, fancy, vivid yellow, and these diamonds, again, are stunning. In order to get a vivid yellow flawless diamond, it's nearly impossible today. And again, investment-wise, these are the type of diamonds that will do the best for you. They'll do way better than stocks, way better than trading in the futures markets, way better than trading in bonds or derivatives or anything like this, because these are hard assets. These are alternative assets that do much better than conventional assets at this particular point. Again, to hold a hard asset or an alternative asset in your pocket, first of all, alternative meaning assets that are not paper or stock or bond related. So basically, gold falls into that category as long as it's physical gold. You don't want to own paper gold. You don't want to finance your gold. You don't want anybody holding your gold. You want it yourself. You want to hold onto your gold, and you don't want to trade it, because what's happening now in the markets is almost unprecedented. We've got all these situations happening around the world that will eventually lead to currency devaluation and inflation, and that's why you want to own diamonds, and that's why you want to own gold. And probably the best example I can give you as to why you want to own diamonds and how it's currency related is exactly what's happening in Canada. The Canadian dollar, which was par with the U.S. dollar for so long, is now about 25% below the U.S. dollar. So that means that if you have assets based in U.S. dollars like diamonds, you've actually seen a 25% increase in your asset from last year to this year without the price of diamond even going up. So if you had bought a $20,000, let's say yellow flawless diamond last year, just based on the currency alone, that diamond's now worth $25,000. So that's how important diamonds are to the currency market, and again, why we've been professing for the last 10 years that you want to own this type of asset. And now the fact that the Argyle mine is going to close and there's not going to be any more pink diamonds, this is an opportunity that we will never ever be able to experience again, because there's no other mine in existence that does what the Argyle mine does, which is produce 95% of the pink diamonds in the world. We love what's happening in the diamond market at this point. In fact, it's going to turn out to be one of the best investments we've ever made. at this particular point, we're building our auction business. Our auction business will be our exit strategy for our clients 5 to 10 years from now. Now, because the currency markets are constantly changing, what we're looking to do now is build our clientele in the United States. Again, because their currency is the strongest at this point, and they would be more apt to buy our diamonds along with our clients in London. So we're working diligently to build our auction business, will eventually be our exit strategy for our clients, and we're the only company that has this. No other company that's in the diamond business has an exit strategy for their clients. They don't own an auction business like ours, especially like ours, because it's a one-of-a-kind. It's a virtual auction. It means that you can attend our auctions from anywhere in the world, from the comfort of your own home, your own computer, and now we're the only company that has this, that you can actually attend our auctions from your tablets and from your iPhone. So we're ecstatic about that. We're always improving our avenues, and this is something that we're putting a lot of money and a lot of work into because, again, it is the future of our business. When it comes time to sell diamonds, we want to be able to use our auction business, and we will have clients all over the world that will attend our auctions. At this particular point, very few people are selling. More people are buying, realizing the fact that diamonds are a very rare commodity. The fact is that they can be sold in other currencies, and again, they're portable private wealth. They're known as real estate in your pocket. You could literally walk around with a diamond in your pocket that would be worth $20,000, and nobody would even know it. You could walk around with a blue, flawless diamond worth $10 million, and nobody would be the wiser. That's why they're so important. And with all these changes going on in the financial world today, and with all the risks out there, as we talked about, the derivatives market could wreak havoc on all of your investments, on most of your investments, especially ones that are stock related. And all you have to do was remind yourself of what happened in 2008 and 2009 when the Dow dropped from 14,000 to 6,500 to understand how important it is to have assets outside of the paper asset market. And if you get caught at the wrong time, and these markets start to plummet and you don't have any protection, all you're doing is going blindly into your investments. You need to own the type of assets that will hedge you against these horrible things happening. And again, most people are just possibly recovering from the losses back from 2008 and 2009, and it's now 2015. In actual fact, another massive drop in stocks and bonds and derivatives and those type of things will mean that most people, especially retirees, will never ever make that money back again. So own the type of assets that will protect you from that. You know, there are assets like gold that will protect you from inflation, and there is no doubt that with all the money being printed and all the debt in the world, that inflation has got to be here. There's no doubt about that, and gold is a tremendous hedge against that. We're going to see massive price increases in the price of gold, but again, it has to fall further before it can go higher, and we'll definitely let you know when that's going to happen. You want to get into the diamond market if you can afford to do so, but it's a longer-term investment. Don't buy diamonds and look to sell them in 2, 3, 4, 5 years. You're just not going to make the money on them. You want to buy them for the long term. Best example I can give you, and I've given this example many times, my wife's girlfriend who inherited a pink diamond from her grandmother. Her grandmother bought it 50 years ago for $50,000. Today the diamond's worth over $5 million. Those are the type of returns. And if you don't need the money, hold on to the asset, put it in your safety deposit box, and give it to your kids and grandkids. Let them make the money. So it's a very, very exciting time. As scary as the markets are today, to own a diamond, like a yellow flawless, especially a vivid or an intense or a fancy yellow or canary diamond, to own an argyle pink today is one of the best investments you could make. And to own a vivid pink argyle, you're going to see massive increases because they're the best diamonds you could buy, and they're worth the most amount of money. So if it's within the cards for you, if you can invest $50,000, $80,000, $100,000, you want to put that money into a vivid pink argyle, and you could see 7 figures back on those investments. We're very, very excited about what's happening. Blue diamonds have skyrocketed in price. We've got a magnificent half a carat is actually a .45 intense blue diamond ring that will take your breath away. It's one of the most beautiful diamonds, and the ring is a $50,000 setting, and it's surrounded by pink and white diamonds. It'll literally take your breath away. And some blue diamonds over the last 10 years have increased by as much as 1,000%. They're almost impossible to get today, and we do have some magnificent blue diamonds that we can offer to our clients as some of the best investment diamonds that you could possibly own. So again, Randy, we're anticipating a huge increase in the price of vivid pink diamonds, and that will lead to intense and deep and fancy pinks following suit. We're also looking that vivid yellows are skyrocketing in price, blues are skyrocketing. It's just a great time to be in a safe asset like a rare colored diamond.
We have a story in our newsletter. Rare pink diamonds are safe haven investments for the super rich. Rare pink diamonds from the Argyle mine in Australia are being invested in by high net worths across the world. Read that article in our newsletter. Our featured diamond of the week from rarecoloreddiamonds.com is an Argyle diamond. Not a pink, but it's just as nice. 0.36 carat, round, brilliant cut, fancy gray blue. And until you see the gray blue together, you really can't get an appreciation for it. You think, oh, gray, I don't know, how would that look? Go to rarecoloreddiamonds.com right now. Click on featured diamond of the week. You will see this diamond. It is spectacular. The way the gray and the blue come together, it is beautiful. And we touched on it last week. A yellow diamond ring is leading Sotheby's Hong Kong sale, their spring sale. The top lot is a 77.77 carat VS2 fancy vivid yellow diamond and diamond ring. The pre-sale estimate on it is $6.8 to $7.5 million. Yellow diamonds have set world records at Sotheby's twice in the past. Most recently, the 100.09 carat Graph Vivid Yellow sold for $16.3 million in May of 2014 in Geneva. Among the other top diamonds, lot, and this is a beauty too, 23.15 carat D, and that is a white D, internally flawless, type 2A Golconda diamond ring, known as the Legend of Golconda. The ring has a pre-sale estimate of about 4.3 to 5 million. Pink diamonds also featured with a 4.57 carat internally flawless fancy vivid pink diamond and diamond ring mounted by Carvin French. The estimate on that, 6 to 7 million. The auction is coming up on April the 6th, and we will have auction results for you on next week's show. Harold has access to these type of diamonds. We're talking not only museum pieces, but we're talking major diamond sale pieces that you can find at rarecoloreddiamonds.com. And Harold, our featured diamond of the week, when you hear fancy gray blue, you really can't appreciate it until you take a look at how those two colors come together. And it's really one of the nicest colors I think I've ever seen when you look at colors amalgamating.
I love the gray blue. Again, they're very, very rare. We've had maybe 5 of them in our entire time that we've been in the diamond business. So to get a diamond of this caliber is extremely rare. Again, most people know that Argyle produces the most beautiful pink diamonds in the world. But in order for a diamond to turn blue, boron has to enter the ground. And that's what turned this diamond blue. The fact that it has a little bit of gray in it is absolutely magnificent, because when you see the diamond in person, it's like no color you've ever seen before. So we were very fortunate to get out of the last batch that we had 3 of these fancy gray blues, but beside that, I've maybe only seen 2 or 3 of them prior to this, so they're extremely rare, and again, diamonds that will definitely increase in value. When you go to our website, rarecoloreddiamonds.com, not only will you see in our loose diamond section our magnificent diamonds, but on top of that, you can attend a live seminar. We can do a live seminar for you from the comfort of your own home. We have a learning center that will teach you everything that you need to know about the diamond market. And the reason that we do this is that we want our clients to be educated. We want you to understand why diamonds are a good investment or why it has such an important role in your overall portfolio. So again, we're willing to spend the time with you, as much time as you possibly need, in order to educate you on the diamond market. And this is all totally free of charge. So when you go to investing in diamonds on our website, not only are you going to see everything to do with investing, but we have a historical price tracking system. That means that you can go back to 1980 and see what certain diamonds were back then and what they are today. All you need to do is go to the investing in in diamond section, click on the chart, and you're going to be able to find a wealth of knowledge as to what's happened in the diamond market. Now, going back to, let's say, fancy yellows, back in 1980, you could have bought a fancy yellow diamond that's flawless for about $500. Today, that same diamond, you're looking in the range of about $20,000 to $25,000. So that's how much this diamond has actually gone up since 1980. So you're talking again that an actual fancy yellow flawless diamond is worth right now about $21,601. But back in 1980, that diamond you could have bought for $500. That's why diamonds give you those tremendous returns. When you look at the best color of all, the vivids, which have the highest saturation of color, back in 1980 you could have bought a 1 carat radiant cut, which is a square cut diamond, fancy vivid yellow flawless for about $2,500. Today that same diamond is worth about $90,000. That's how much these diamonds go up in value. So again, and they're safe. They never decline in value because there's so few of them. So go on our website, go to the investing section, and learn everything you can about investing in rare colored diamonds. Then on top of that, you can sign up for our Investor Learning Center, and we will teach you everything you need to know about the diamond business, how to read a GIA report, what colors have more saturation than other, and everything along that line. So if you're interested in learning how to make money in the rare colored diamond market, go to rarecoloreddiamonds.com, go to the investing section, and have a lot of fun, because there's a lot of knowledge in these pages. Along with that, we have our media. We've been interviewed 4 times in the last year on Bloomberg and on Fox News, and it's primarily because there is so much interest in the rare diamond market and alternative asset market that we're the go-to company when it comes to that, and we will have some upcoming interviews coming up again very soon. So, Randy, it's just an exciting time to be in a market that is not volatile like the stock and commodity markets, where you don't have to worry about going to bed and waking up in the morning and finding out that you lost all your money like you could in the stock market.
And we can send those interviews out to you. Fox Business News interviewed Harold, Bloomberg TV, Jerry Bavino show, and we have a PDF file report. It's from Bain & Company, Diamonds, Timeless Gems in a Changing World. And it will really open up your eyes to the potential of the diamond market going forward, due to what's happening about the Asian market opening up in a way that it never has before. And there is a collection, a catalog. It's the Diamante Atelier, the collection 2014-15. It's a catalog that a lot of people have taken a look at and are just stunned at the beautiful diamond jewelry that Harold has on offer. Don't forget, if you're interested in our beautiful diamonds, all you need to do is connect with Harold at rarecoloreddiamonds.com. rarecoloreddiamonds.com. Our featured diamond is a .36 carat round brilliant cut fancy gray blue. rarecoloreddiamonds.com. Call Harold at 1-800-432-1022. And Harold, with about 30 seconds left, you take a look at the world where a Treasury ETF that bets on a rate rise has lost $6.1 billion. We heard about a hedge fund that lost close to $1 billion when it bet against the Swiss franc appreciating in value. There was a hedge fund that made $1 billion on the oil market going down. You need to be in the right market at the right time.
You summed it up beautifully, Randy. These are very, very dangerous times. Don't speculate. Be conservative. Own assets that you can hold in your hand, that you own outright. That's my best advice at this time. And we're going to get through these difficult times and hopefully make an awful lot of money together.
Thank you very much, Harold Siegel.
It's my pleasure. I wish everybody a wonderful weekend and a very profitable day.
If you would like to speak personally and privately with Harold, he would be happy to do that. Always an open invitation to speak with you, and you can connect with him at rarecoloreddiamonds.com, 1-800-432-1022, featured diamond of the week, and you can find it at rarecoloreddiamonds.com. 0.36 carat round, brilliant cut, fancy gray blue. Speak with Harold about having that added to your diamond portfolio or starting a portfolio today. That's it. Another edition of the World Financial Report on Radio with Harold Siegel and me, Randy Marshall. We will talk to you next week.